recipes for technical trading success in Cook's Kitchen.
Kevin Cook here, and today we're going to talk about why the S&P 500 is still expensive. And we're going to do that by introducing the equity risk premium. Sounds complicated, but the math is super simple, and it's a great tool for looking at what's going on with earnings right now. All right, why the S&P 500 is still expensive. I said we're going to look at the equity risk premium. We will, I'm going to give you the easiest way to think about this. Like if you Google equity risk premium, you're going to get these academic papers with a bunch of math. Even your standard website makes it way too complicated, and it's really simple. In short, the equity risk premium is how much investors want to be compensated in potential earnings from stocks above the risk-free rate. In this case, we're going to use the 10-year yield as the risk-free rate, which is currently like 3.3%. And we talk about the ERP, the equity risk premium, on the entire stock market. So we have a way of taking the earnings of the S&P 500 and comparing that yield to the 10-year Treasury. I'm going to walk you through the math. There's a little preview of it. But first, I just want to show you the piece that I wrote on Monday, or actually Tuesday, for Zacks Confidential. This is a newsletter we put out every week. Our strategists come up with a topic and just dive in. And I'm saying get ready to buy a September swoon, because I think that stocks are still expensive. They're going to come down in September, and you want to be ready to buy. That's my boss right there, the executive vice president of Zacks.com, Kevin Matris. He introed my article with his short synopsis. And then what I did is I profiled, you may have heard of a strategist from Morgan Stanley named Mike Wilson. He's the chief investment strategist for the U.S., and Wilson is a bear. He's been a bear for a while, and back in late August, he was saying that stocks were still 15% too expensive. So he was looking at the bear market rally. Stocks, we got up 4,300 on the S&P, and he was saying, hey, that's too expensive based on what's happening with earnings. So we're going to look at the earnings deterioration, but he talks about the equity risk premium. And so I thought, well, it'll be good to explain that to people. Because it's a core mathematical function for him to talk about why the market's expensive, because basically the other than interest rates going up, the biggest trend we're seeing is that earnings are coming down, both the estimates and the actuals, and you see it, every earnings report. But I'm going to show you some stunning facts of how this is happening. So this is Mike Wilson's thesis. We have increased risk to earnings coming up here in Q3 and in Q4, possibly a bunch of next year. All right, so let's go back to the slides here and walk you through this. So I gave you the short definition of what the equity risk premium is. Explain it a little more detailed. The long version is we need a simple way to compare corporate earnings to a risk-free rate like the 10-year Treasury yield. So the handy math is you just take the PE for the S&P 500 and you flip it, take the inverse of it, and you get something called an earnings yield, or the earnings yield. So here it is. So let's say that the S&P 500 index is at 4,000. It's a little above 3,900 today, but we'll just use 4,000 for some simple math. And we divide that by what is the projected EPS for the index. Now, this is a number that's not talked about too much, is earnings per share for the S&P 500, but you can find it in certain places. And our director of research, Shiraz Mian, always has these numbers handy. So let's just do the PE on the index, 4,000 divided by 240, which is, projected 12 months forward EPS for the index, gives you a PE of 16.7 times. Not terribly rich, not like what it was 21, a year ago. But what matters is what's happening with earnings. So, and is that 240 still a solid number going forward? That's the big question. So there's your PE, 16.7 times. Now you could just do you take the inverse of that, 1 divided by 16.7, and you would get 6%. So either way you want to do it here, if we take EPS on the second line, if we take EPS of 240 divided by 4,000, you get 6%. That is the earnings yield on the S&P 500 right now, roughly. Okay, 6%. Well, that seems like a good yield, right? If treasuries are you get a risk-free rate of 3.3%, and you can get 6% with stocks, seems great, right? But it's all relative, right? So to get the actual ERP, we need to subtract the risk-free rate of 3.3% on the 10-year from 6%, and you get 2.7% for the ERP, equity risk premium. How much investors right now, currently, the way things stand, how much excess return are they demanding based on where earnings are and where the index is? So that's how you calculate ERP. Now, is that ERP enough? And if interest rates are still going up and earnings are still coming down, it's probably not enough, because that ERP is going to get smaller. So you're not getting compensated enough. All right. Now, so what's going on with earnings? Well, we've got a big deterioration in Q3 earnings already. Now, this happens all the time where in every quarter, during the first 2 months of a quarter, analysts are busy refining their models, getting more granular, what's going on with the company, what's going on in the industry, what's going on in the economy, and they start to fine-tune their estimates. And generally what happens is they tend to bring them down, in aggregate. So July and August, which is the first 2 months of the quarter we're in now, Q3, had major EPS revisions like we haven't seen in a while. They came down almost 5.5%, 5.3, 5.4%. This drop exceeded all averages going back 20 years. In any time frame you look, 3 years, 5 years, 10 years, 20 years, the first 2 months of this quarter of 5.4% drop in EPS exceeded all averages in any time frame. That's a big deal. All right. So now let's go to some of Shiraz's data, so you can see nothing like a good picture. And I've got 5 pictures from Shiraz here to show us. So this is what it looks like. Here's the evolution of Q3 earnings growth estimates. This is one of my favorite things that Shiraz does, when he shows us how have estimates changed over time. So this graph starts with the beginning of June, 6/1/22, and look at 6/15/22. It was projected that Q3 was going to grow 8.1% for earnings, and things start to slip a little bit. By the 4th of July, we're looking at they're only going to grow 7.2%, and this is aggregate S&P earnings, and then they slip further. Look where we are now. I mean, 2 months later, we're barely going to see any growth. 1.4% is now the projected growth. All right, so that tells you something's happening here. And I mean, that just reflects what we just saw, that for the first 2 months, earnings were revised downward by a chunky 5.4%. Now, here's the other thing that Shiraz really does well and teaches us. You've got to strip out energy right now, because energy profits are gushing, pardon the pun, but they are. So the S&P, you could say, is being held up by energy. So if you take out energy estimates, look what happens to the profit picture. There's your 5.3% decline, because basically energy is holding things up. All right, let's keep going here. Our next picture, worth 1,000 or 10,000 words. Here's the aggregate number. Before, when I showed you the equity risk premium calculation, I used a S&P 500 EPS estimate of $240 per share. That was sort of a 12-month forward view. Here's just this year's view. We're already almost through Q3 here, so we have a rough idea of what it's going to show up like. And so Shiraz is looking at $220 EPS. Okay. Well, and the number really doesn't matter. What matters right now is the direction it's going and the rate of change. Remember those two things. Which way are we headed? Earnings are headed down. And how fast are they headed down? Pretty darn fast right now. So since we just had that over 5% walloping to Q3, and who knows what the real results are going to be like and what the outlooks are like, and then how much they trash Q4 estimates. So let's keep going here. Now, another cool thing that Shiraz does, he looks at the aggregate profits in billions. So those numbers up there, 2 with a comma, that's 2 trillion. So we're talking aggregate profits for the S&P 500. And this is the evolution again. Over time, what has happened here since the beginning of the year in terms of the projection of the aggregate profits for the S&P 500. I think it's just fun to look at this because, when you realize that, the S&P 500 is earning over 2 trillion in profits, it's pretty stunning. But look how it slipped. We got to a peak in mid-June on, optimism about the economic recovery and, whether or not inflation would take a bite out of things. And we were up to nearly 2.2 trillion, 2.18. But that has slipped now below 2.1 trillion. So just around 2.1 trillion. Okay. That's just fun to look at, to see the cash pile coming out of the U.S. companies. All right. Last thing we have to do is we have to look at it. Take away energy. Look how much it's slipped, right? So you take energy out of the picture and profits are falling fast. So this is the way we need to look at the market right now, and why I say, Mike Wilson says, and I'm saying too, that the S&P 500 is expensive. It means that earnings are still at risk, as he likes to point out. And so until the results are in for Q3, which we won't know for another, they won't start coming in for another month, and the outlooks, then we'll know how much damage has to happen to estimates in Q4. But I think a lot of this is getting priced in. So, let's use an extreme example. I used S&P 4000. Where does the market look really attractive? Well, it would look really attractive at S&P 3000, right? Then you'd have an earnings yield of like 8%. I'm just roughly guessing here, like S&P, let's say 240 bucks EPS divided by S&P 3000. That's got to give you an earnings yield over 8%. And then when you take 8% and subtract 3.3%, you get an equity risk premium close to 5%. We'll call it 4.7%. That is a much more attractive yield. You're getting paid more for your risk to own stocks. And as long as the direction of earnings estimates is going down and at the accelerated rate that they're going down, large investors are going to be waiting for better buying opportunities. I'm hoping we get one here in September, and I have a list of stocks I want to buy. If you want to see that report with the 3 stocks that I recommend buying, just send an email to ultimate@zacks.com. ultimate@zacks.com. That's our premium membership. And tell them Cooker sent you, and tell them you want a copy of the Zacks Confidential that I did on Tuesday, September 6th. Thanks for joining me in Cook's Kitchen. I don't do a video every week, but hey, if you leave me some likes and some comments on YouTube and your suggestions for other topics I can do, that'll get me motivated. All right, we'll talk to you soon.